Welcome to Friday, another Talk Money with Tom show today. Really glad that you can join us after the nice holiday break that we all had. I hope you had a great Thanksgiving. Today's show, of course, is focused on trying to help you accomplish a more successful retirement. Whether you're looking forward to retirement or already in it, a lot of the questions that we cover should be able to help you no matter what situation you're in. And so that's the format of the show, is kind of a question and answer. You can send in questions to Ask Tom at talkmoneywithtom.com. You can put it into the chat here as far as that goes. And then Eason, who's another one of our advisors, is joining us again today. He'll be asking the questions and kind of going through them, and then we'll go back and forth to try to fill them out. And we're really big believers that the more you know about retirement planning and tax planning and asset management, the better your retirement's going to be. So if you're interested in continuing, your education, you can subscribe to the channel and push the little bell if you want to get, all of the content that we're downloading here. Or you can send us your email address so we can send you when we do update the content that way. Or obviously you can just set an appointment with us too if you'd like to have a conversation. You can go to our website, hit the book appointment button, and have a 30-minute video or phone conversation with us also. So really fun, really enjoy this. I hope that it is helping everybody here, just kind of building up that concept. And we've got a lot of great questions, so keep those coming. You can send them at any time during the show, during the week, whatever that might be. So look forward to that. But I always do like to start the show with a summary of kind of what's happening with the market. And we've had in this last 2 weeks now some downturns across the market, really kind of peaked out in early November. So I think this is a really great time to kind of do what I call Positive Friday. The idea behind this is I'm going to go through what I see as the positives in the economy and the stock market. And the idea isn't so much that I think things are going to go up, constantly forever. I'm not that person, but matter of fact, right now I'd have to say that probably the market comes down some more from here just because we have this little downward momentum. But I do think it's really important to understand what is positive so that as we're going through these downturns, you kind of have some balance. The stock market is a representation of human emotion, and specifically kind of fear and greed. And fear is a much more powerful motion. You can even see it in the stock charts. You see this kind of slow upward motion and then sort of what looks like a cliff on the downside. And so that's why, as a group, we tend to click on negative articles more often. And that's why we see more negative articles about the stock market and the economy. And it's very difficult to find this positive information. So I like to kind of gather this all together, once in a while and just kind of go through it and let you kind of get a balance between this negative that we all know about and the positive that is out there. These are all facts. And hopefully that helps you kind of decide what to do during this time periods that we're dealing with now. So let's start with Omicron. So obviously this was the big news, specifically on Black Friday, that's been kind of creating, waves throughout the market as far as that goes. It seems to be quite transmissible, has lots of mutations. But one of the things I would caution people about is that we just don't really know that much about it yet. We are seeing cases that seem mild so far, but we don't know the severity of the symptoms that are happening. The World Health Organization did come out today and say that they don't have any reported deaths so far from the Omicron variant. And I think that's interesting. And they're asking for people to not panic, which is, I think, good advice as far as that goes. And so here's one of the things that I look at, though. We've been dealing with variants and this virus for over a year and a half. We've had an unbelievably good stock market in that time frame. And if you even just look at the last big variant, the Delta variant that's out there, retail sales were up as the Delta variant was here. We ended up with unbelievable earnings that happened during that time frame. And so people are still spending money and things are happening. And every single wave that we've had throughout this entire pandemic has had less and less economic impact. And so hopefully that's true for this particular one also. Matter of fact, the president this week came out and said that they weren't expecting any, lockdowns and things like that that might really hurt the economy as far as that goes. We saw a report today that factory orders were up. 12% of the economic activity is related to factory orders. So that's a really good thing. We've had negative news in a way this week from the Federal Reserve talking about them cutting back their stimulus faster. So they're buying bonds and they're keeping rates low, and maybe they'll move that, up in terms of what they were talking about before in terms of reducing that stimulus. But the one good thing there, if you look at it kind of from the other side, is that one of the big concerns for the market is inflation. And when they cut back on that stimulus at a sooner rate than they were planning, that might also help to mitigate inflation, which would be very good for the market. When inflation gets really hot, it's tough for companies to control their costs, and sometimes that can hit their earnings. And so that's what people worry about with that. So the Fed moving quicker has that positive side to it, that it could help fight inflation. Now, we had a labor report that came out today, and so it was 210,000 new jobs created. The expectation was for 573,000 jobs, so that's a pretty big miss. But I think if you back up for a minute and just look at the total picture, it's unbelievable how many jobs have been created month after month after month since the bottom of this pandemic. The job market is pretty darn healthy right now altogether. Unemployment has dropped all the way back down to 4.2%. It was at 3.2% prior to the pandemic, so we're getting there. And even if you look at kind of the overall unemployment picture, which would include the unemployed, the people that have fallen off of the unemployment rolls that are still looking for work, and those people that are part-time, that are looking for full-time work, that number has dropped all the way down to 7.8%, which is the lowest we've seen in the pandemic. You have wages increasing, which is inflationary effect, but it is also a stimulative to the economy because people are making more money, they can spend more money and what have you too, as far as that goes. And then first-time unemployment claims last week were the lowest since 1969. The job market is really healthy, even though today's number wasn't up to expectations. If you look at the big picture and you look at what's been happening, this is not looking like a depression area time frame with that type of job growth as far as that goes. There's now some concerns about the debt ceiling because we were, moved the debt ceiling forward and it hasn't been moved again. It needs to be sometime between the middle of December and the end of January is kind of the time frame that they're saying the debt ceiling needs to be increased. There's some conversations happening right now in Congress to try to figure that out. We've never defaulted on the debt ceiling before. I would guess that we're going to get close, like we always seem to do, because it's sort of a political football. I think the best piece of news I can give you about the debt ceiling is that there's now finally a bill in Congress that has bipartisan support to change the way we do the debt ceiling. We will not have to deal with this again if they can get that bill through, which would be, I think, a huge positive. Just looking at the market itself, if we look at kind of the price and the way that it's moving, the momentum of the market is unbelievable. We've had an unbelievable run all the way through this. And even though, our accounts are all down from early November, they're certainly up from this entire time frame, up for the year and all those types of things. The 50-day moving average, the 100-day moving average, the 200-day moving average are all up and facing upward right now. So, things can change. We'll have to watch for that. But the momentum for the market right now is definitely up. If we look at Christmas sales, so Christmas sales right now are projected between $843 billion to $859 billion. That would be an 8.5% to 10% increase over last year. Consumer spending is super healthy. The economy runs 2/3 on consumer spending. So think about that as we watch this market fall right now. And I think one of the other key things to think about is what's happening inside of these companies. So they're what they call insider buying. So these are people that own or work for these companies that are public. They're buying stock. So since this market started coming down in early November, we've seen a pretty good spike overall in insider buying. And what that means is that the people working there are probably working pretty hard because they're really busy. They're seeing sales come in, they're seeing their earnings grow and those types of things, and they're seeing their stock price come down, and they're pulling money out of their pocket essentially and buying that stock. I think that's a pretty good sign as far as that goes. And then we have inflation, which I think is a really big area to focus on. It's important to see what's happening there. And we've seen some really interesting things just now. So commodity prices and shipping rates prices have both fallen just recently. Those are really good early indicators that inflation could be softening. Another thing that we look at is the 10-year Treasury yield, which has also come down. Again, historically, that means that inflation could be moderating here in the future. And the other part of 10-year Treasury yield falling is a big deal, is that it makes mortgage rates lower. So if you think about housing, housing is a huge component of our economy. Real estate agents, mortgage brokers, title agents, contractors, electricians, plumbers, et cetera, et cetera, et cetera. The more that housing can be created, sold, refinanced, the more it impacts positively the economy. And when interest rates come down in the 10-year Treasury, that generally relates to interest rates coming down on those mortgages, which stimulates the housing market. That's a really big deal. And so that's been going on right now as far as that goes. And the last thing is just earnings. All right. So all of this stuff, right now we're kind of in this vacuum where the only news we're hearing about, the Federal Reserve, Omicron, the debt ceiling, is all kind of negative. And that's exactly what happened, if you think about this, back in September and early October, until earnings started to be reported. And earnings were fantastic in the third quarter. And so, again, I think that might happen again here as the next quarter of earnings starts to be reported next year. I think we'll probably see some pretty good numbers. Look at Apple is supposed to sell 40 million iPhones between Black Friday and Christmas. How bad can things be when things are going along those lines? So I do think this is a temporary pullback at this point in time. If that changes, I'll change my tune. I don't try to make predictions. I really try to make reactions to what's happening to the market. But I do think it's important to have that balance and to have an idea of what's going on the positive side, so you can look at that and say, okay, I've heard all these negative things, and here's this positive piece. And so you get some idea for what's going on. And I think there's a lot of positives right now too. So something to consider. So, let's keep looking at this. Let's keep watching this and see what happens. And we'll talk about this again next week. All right. Look forward to the questions here, Easton. I know we got some this week. Some of these questions, just so everybody knows, come from some of the appointments. We have strategy sessions with the clients, and so sometimes something comes up that I think that should be discussed. So everybody can kind of hear it. We don't divulge any private information or anything along those lines, but just generically what was asked, and hopefully you can learn something from somebody else's question.
So, first question: when should I consider increasing or reducing how much I withdraw from my accounts?
Yeah, it's a good point. Because there's all these withdrawal rules, and take out 3%, take out 4%, take out 5%. There's all kinds of. There's a lot of articles on that, which I think is interesting. And so, one of the things that's kind of interesting, if you actually take a percent, right? Let's just say 3%. Let's say I have $1 million. I take 3% out. That's $30,000 a year. And so then if my, value of that account drops, so would my income drop because I'm taking out 3%. That's actually fairly, I think that would work pretty well, at least in my experience. However, what I have seen is that people don't do that. So in other words, if they were taking out 30,000, they've now locked in a lifestyle around that income, and combined with all their other income, Social Security and pensions and rents and those things. But and all of a sudden the market falls, and they still want that 30,000, and that's okay. Like in these type of downturns we're having now, they're kind of small. There's no real problem with that. But once we get kind of a bigger downturn that's really rolling to the downside, 2008, a 2000 downturn, those types of things. There probably should be some consideration for cutting back on that withdrawal, really no matter what it is. Hopefully it's not too high. Sometimes people are taking out too much to begin with. If you're taking out 10% of the value of your accounts, there's almost no market that's going to work for very long. So, there is some For those people, you should be cutting back no matter what the market is. But for the rest of us who are kind of taking out something, somewhat reasonable, what I recommend is just be, able and willing to just kind of cut back a little bit in these bigger downturns. And the ideal scenario would be that you'd have some two components. Number one, the ability to cut back, what you're spending a little bit. And number two is maybe some cash buffer on the side so that, you could start to use that cash buffer for a while. And as your market market accounts are kind of falling down some because of these big downturns, and then that way you're not pulling so much money out of it. So, for example, if I have it's kind of an extreme example, but if I have $1 million account taking out 30,000, that's 3%. But if that account drops to 500,000, I'm still taking out 30,000. I'm now taking out 6%. It makes it much harder for that account to get back to $1 million. But if I could cut back, right, what I'm taking to maybe 15,000, still keeping it at 3%, and if I needed more money, I could get that out of some kind of cash buffer. So I think the cash buffer allows you to, alleviate some of the pressure that you're putting on some of your assets in that regard. So, there's percentages, there's actual dollar amounts, there's different things that people are looking at. I'm a huge advocate of being prepared for downturns in lots of different ways, but one of which is having a lifestyle that isn't completely fixed and locked in so that that's why if you can pay off your mortgage, that's awesome. And it just gives you some ability to cut back on some of your discretionary things a little bit. 2008, we all kind of did that anyway. And then secondly, to make sure you have some type of a cash buffer sitting there to live off of for a while. Maybe you can replenish that as the markets come back as far as that goes. But I think that's the best way to handle these situations as far as that goes and still stay, invested. Because unfortunately, we can't put everything in the bank because inflation is 6.2%. Last month was the report. We're not making that in the bank. The only places that really seem to do a great job of keeping up with inflation are real estate and stocks. So we have to have something out there for that purpose. Unless you have tons of money. If I have $10 million and only need 30,000 to live off of, that's a different scenario. I can have everything in the bank probably and make that work, but most people don't. They kind of have something, that they need to have out there. So if that's true, then having a strategy of a flexible spending strategy combined with some cash buffer, I think that's the way to go.
How many clients actually use like a percentage of withdrawals based on assets versus kind of like a fixed amount? Would you say a majority use like the fixed amount?
Well, no, I'd say majority actually use a percentage for a starting point. So, in other words, we get into retirement and we say, okay, what can we use? And we'll back test this using the Monte Carlo simulation and figure out, okay, 85% to 99% probability on Monte Carlo simulation, how much money can we spend? And it's usually some percentage, I don't know, 2% to 5%, someplace in there. Depends on the situation. And so it usually starts off as a percentage, but again, what then happens is it becomes like a salary. So I'm getting 30,000. And so, I'm using that, for whatever purpose that I might be, spending that on. And then all of a sudden, the accounts drop, and a little bit of drop. That's not a problem. That's normal. Like what we're dealing with right now, don't worry about it. Matter of fact, anything, probably up to 20% isn't a really big deal. Usually that works its way out. But just being prepared, to be able to kind of pull that back. So yeah, I'd say it starts off as a percentage oftentimes, although the way we do it is a little bit differently. We solve for how much can be spent to meet the required, in our opinion, success meter in using the Monte Carlo simulation. And I don't really want anybody to be below 85%, and that's actually a pretty good number altogether. But obviously, it's even better to be at 90, 95, 99% probability of success with the amount of money that you're spending. So it just the whole objective is to make sure that you don't get deep into your life and find out that you don't have enough money, because it's really hard to make adjustments at that point in time.
And when do you consider increasing that amount? Usually, like sometimes, a big sum of money comes in from an inheritance or a stock, does well and has an IPO or something like that. When
Yep.
do we start reconsidering our amounts?
Yeah, it's funny. Most of my clients have a hard time increasing that amount, even when they can. And that's the funny thing. I mean, they think 30,000 or whatever it is, and they could spend 50, still be at 99% probability of success, but they're uncomfortable spending more. Now, not everybody. And so for those people that are interested in being able to kind of spend more, as your assets grow and you have more success, and I have a few clients that are doing this right now where they're kind of spending a bit more. I've just kept telling them it works, right? The markets are great. Things are doing well. You've exceeded expectations in terms of your overall returns, but just be prepared, right? If things do fall, just be prepared to kind of cut that back as far as that goes. So, yeah, you can test that, right? Pick a number. So I want to be at 95% probability. How much money can I spend? Let's say it's 45,000 and I was spending 30. Again, it's just plus all the other incomes, right? So I'm just talking about the stuff we're dealing with that might be coming out of that $1 million asset base. So go ahead. You can probably spend the 45,000. Just be aware that when things fall down, that 95% probability might come back down to 30,000 again. So you have to be able to kind of, what you're spending the money on has to be flexible enough for you to kind of cut back on it or have a big enough cash buffer. So, but it is interesting. I don't have a tremendous number of clients moving up when things go up. They're much more interested in moving down when things go down. And that's why they have money. That is one of the keys. One of the key success factors to wealth seems to be, at least within my clientele, is the fear of running out of money, no matter what they have. And there's nothing wrong with that, right? That's a good trait to have, apparently, because these people are incredibly financially sound as a whole.
So one of the common questions that come up in client meetings is my account is down since the beginning of November. Should I be doing anything about this? Should I be preparing or doing something, cutting back?
Yeah, exactly. So, we hit a peak early November. It's been not a big drop, but it's been a drop. And so people see that, they get nervous about it. What should I do? Those types of things. So number one is you got to make sure that client or you have the situation in place where you have the right amount of stock versus bond. You're in the right risk realm. So if you look at that and you get nervous about how much it moved down, then maybe you're not in the right spot. So maybe once things settle down here, we kind of settle into more bond and a little bit less stock. So that's one of the first pieces. But generally speaking, these little downturns that we have, these are normal. I mean, it's the 5 to 15% downturns are happening pretty much constantly. And so I'm not too worried about it at that point in time. I look at kind of that overall trend and how things are going, and things are still good. Sometimes it's hard to convince ourselves that we're still in an uptrend when things are falling, even for a couple of weeks. And there's, of course, all the bad news out there just makes us really scared, which is why I do these positive Fridays like I did today, because at least it gives us some balance in the thought process. I think, get your thoughts in a balanced position where you understand the positives to go with the negatives, including the negative of looking at your account and seeing that it fell, right? Just understand that there's, whatever it is that works for you. For me, watching insiders buy right now, I don't know. That's a pretty interesting stat. I mean, that means something to me. It helps me when I watch my accounts fall. And so, those types of things that are out there, in terms of cutting back what you're taking out and those types of things, this is too small of a downturn to really make any adjustments at this point in time. Again, talk to me at some point later and we'll see what happens. But right now I would be, kind of holding the course, and, I will make adjustments to the portfolios as I see things that need to be done in terms of, what's going on. But right now, things seem to be okay as far as I'm concerned. I see enough positives to kind of at least balance out some of the negatives. I do think it's going to go down more from here. I just do. It gets a little momentum one way or another. This is what I call a counter cyclical trend. So the major trend, is up, but the counter cyclical trend right now is down. That could change, but I'd be really surprised. I mean, rates are still at zero. We still have stimulus coming in from the Federal Reserve. There's just so many positives. I think people are going to come in here and start snapping these things up, especially once they move that debt ceiling up. That is one issue that will continue to hold the market at, from flying upward, is that, all right, that worries the major managers of money who manage risk first, return second, are got to be looking at that debt ceiling thinking, okay, we need to see that thing move up and out, as before we're really going to start running back into the area. And then again, I think earnings coming would help, right? Because the earnings were so fantastic in the third quarter. I think so far everything we've seen says to me that things could be quite decent overall. Individual companies can have trouble, right? There's no doubt. But the overall market, which is basically what we invest in for the most part, is the overall market through these exchange traded funds, could do quite well. So anyway, that would be my outlook.
So this is a tax question. With the IRS pushing up income tax brackets in 2022, how will this provide income inflation relief?
Yeah, that's actually a really interesting question, because what they're asking is about like, for example, the 24%, the top of the 24% tax bracket for 2021 is 329,000, right? So if you make up to 329, there's a chunk of your money that will be taxed at 24%. If you're making more than 329, that part will be actually taxed at 32% for the feds. And so they're actually increasing that from 329, for example, to 340,000, which is a pretty big jump because the brackets are indexed to inflation. So obviously the reason they're moving up is because inflation's been high, but it does give some relief because now you're spending more money at the grocery store and all these different places, right? And probably going to continue to be somewhat of an issue, but maybe that tax is less. So, again, everybody's in a different bracket. I'm just using one as an example, but they all moved up. And so what that means is if you made the exact same income next year, you would actually pay less tax, which is a good thing. And so that I think is important, potentially less tax. I think that is important. I think that is somewhat of an inflation relief as far as that goes. And, that part of being indexed is a good thing in an inflationary environment. At least there's some relief there.
So we got another inflation question. Could investing in international markets be a hedge against U.S. inflation?
Ooh, that's a good question. Okay, so when you invest internationally, you are investing in a foreign currency. And so what happens there when your rate of return is calculated, it is really converting that currency back to US dollars. And so if US dollar goes up versus that foreign currency, then you end up with a loss on that part of the return. So think about that for a moment. When inflation goes up here in the US, that usually drives the bond yields up. And that attracts more money into the US from outside the US. And when they're doing that, they're taking their foreign currency and they're selling it and basically buying dollars, which drives the dollar up. So the more inflation we have in the US, the more the 10-year treasury, for example, theoretically would go up in yield. The more the dollar goes up, the more your investment could come down in that foreign investment. So then the only way you're going to make more money is if that country happens to have a better rate of return for some reason. Maybe they have lower inflation, although I don't normally see that. Inflation's kind of worldwide, generally speaking, and maybe that would help their markets do better. Because if you make 15% in that market in terms of appreciation on those stocks, lose 5% to the dollar appreciating, you still make 10%. That's pretty good. But I've been tracking, I track 2,400 ETFs pretty much on a daily basis, including basically every single country that has an active market. And there are countries once in a while that pop up that are doing better than the U.S., but overall the U.S. is a fantastic investment arena which just makes the dollar that much stronger because not only the bonds would be going up in that inflationary environment, but because our stocks have been going up, people are buying outside the country are buying US stocks. They'll buy the S&P 500 or whatever it is. And so that currency exchange coming in drives the dollar. So when you're looking at international investments, unless there's some kind of hedged investment that you're looking at the relationship between the dollar and those foreign currencies as a whole. So I don't know that investing in international would be the key inflation component. I certainly wouldn't be looking at it that way. I'd be investing international because it was doing better, period. Whatever that would be. Sometimes emerging markets take off for a variety of different reasons, and those can be fantastic investments. Sometimes Europe is doing fantastic. Right now, for example, Europe is struggling more in the stock market because they're doing more lockdowns. We're not doing lockdowns here in the U.S. So again, theoretically, there's a more possibility of economic growth here without the lockdowns than you're going to get in Germany and Austria, for example. It's really interesting. I think there's other aspects that I look at for international investing, and I love international investing, but we haven't really had a lot of exposure just because the U.S. has been the place to be. I'm going to be the place to be until there's some other, again, I don't make predictions. I don't try to guess that the international is going to do better and then go sit over there and watch my money, do nothing. I wait until I see some action. I surf waves. I look for, I'm sitting on my surfboard waiting for a wave. And all those waves have been here in the U.S. at this point in time. And most of the waves that I've seen that are outside the U.S. just haven't really developed and haven't been maintainable. That'll change, because eventually those will be fantastic investments, but that's not what I'm seeing right now.
Yeah. So here's another planning question: is what factors should I think about when I'm downsizing or considering downsizing?
Yeah, I guess I could put that because downsizing is a word meaning I'm going from bigger to smaller, which could be local. It could be, someplace outside of the locality that you're in now. Um, I've actually not very commonly seen, at least in our area, local downsizing. So I've got a 3,000 square foot house. I'm moving into a condo or whatever, and I'm going to have this differential between, that, um, you know, price I'd get for my 3,000 square foot house versus this condo. And so mostly what I see is people moving out of the area, just because again, they can get, if they get something smaller or even the same size, it's often cheaper. And then they're capturing that difference. And that's why we have so many clients all over the country, because they've moved from here and captured their home and moved, someplace else a lot cheaper. Sell something here, in San Jose for $1.5 million, buy something in Arizona for 400,000. So you get to keep the difference, so to speak, after taxes and other costs. But so really, it is important. You can look at all kinds of different things. There's a bunch of aspects that I would look at. One is tax and total cost. So there's lots of different taxes. Like Texas doesn't have, for example, a state tax, but pretty high property tax. So got to look at the whole thing, try to figure that out, and we can model that inside of our financial planning program, which I think is kind of neat. And so looking at the overall ramifications in terms of financial. It's going to cost this much to move, this much to, add to the new home. Here's what we're getting from the other home. Here's the taxes, the real estate cost, agent cost, those type of things. And we can model that. And oftentimes when I've done that here, it's a positive. People have better success ratios because, again, homes are so expensive here versus where they're going. But we do need to look at a lot of other things. I highly recommend people look very, very strongly at the medical in that arena, wherever it is that they're going. Because if they end up, oftentimes these are older people. They end up, in a place that doesn't have good medical, and they end up with a situation that needs that. There's all kinds of problems. Seen a lot of people move up into the foothills of the Sierras here, where the medical is not that great, and then they end up with cancer or some other issue, and they're running down to Sacramento or whatever it is. So you might be better off, really going to a place that has great medical as far as that goes. There's all kinds of lifestyle issues that deal with, what's the weather like? What weather do you like? Is it a college town? Do you want to do some of that? Is that important to you? All of those aspects. We generally end up, kind of dealing with the financial aspects of looking at different things as far as that goes. So um, I think those are some of the key pieces that I can think of that, are out there for that aspect. Uh, Again, I've had a lot of clients do it, and they've been pretty happy. I get to talk to them every 6 months and ask them how it's going, what they like about it, and what have you. And I haven't heard anybody have a really bad time where they ended up, other than that medical situation. I've had people that had to move back because of medical situations, but we have great medical here. UCSF, Stanford, etc., is fantastic. So sometimes you can't get that in other places.
So, how have your clients liked, I guess, retirement communities, and those kind of communities that are geared towards people that are in retirement?
Again, I think people that go into these retirement communities are predisposed. They're social. They love all that stuff, and it just ramps up the social because there's so many things to do. You can play pickleball or go. There's hiking groups and there's woodworking groups and so I think one of the things that does happen once you leave work sometimes, if you're really somebody who likes the social aspect of work, that gets diminished sometimes once you get out of work, and that can be replaced by all these different organizations. I've seen some of these places where they have over 100 different groups that do everything from bowling to poker to whatever it might be. So kind of whatever interest you have. People really like that, right? But then I get other people that don't move into those places because they don't want to be in a place that has kind of all one age. They like kind of a mix of ages or, that kind of thing. So um, I think the people that I've talked to that have moved to those places are happy, but I also think that they pre-selected that, situation because it was something that they knew would be something they'd be interested in. Yeah, but yeah, I would say overall, again, and I've been through this situation a lot of times with clients. They're quite happy with the move that they made. Again, the one caveat being a big medical problem that comes up, and they're just not in a place that can handle that. So, other than that, yeah, people seem to do a really good job of picking a place that they really like, and it could be anywhere: North Carolina, Tennessee. We've got clients everywhere, all over the country.
So, this next question is, what should I do if I'm way behind in my retirement savings? Like, where should I be at a certain age?
Ooh, yeah, actually, I mean, if you're way behind, it, first of all, you might be surprised at how much you're not behind. I've had so many conversations with people that are actually doing okay as far as I'm concerned, but they feel they're way behind. Again, that is a success trait. People that worry about not having enough money end up with a lot of money. And so there's a lot of people. So that's the first thing I would be looking at is like, well, are they really behind or not? And so let's say you really are, and have, understand that so many people 50, 55 are way behind or younger, and they're able to still accomplish a pretty decent retirement because they're highly motivated. They're heading into that retirement, and so they you can find ways, and saving for retirement becomes like one of the most important things that they're doing. And so it isn't even as far as the ages go. So in other words, people don't just continuously save from 20 evenly all through and add up. I've seen that. There are those people, they do really well, but boy, they're rare. Most of the times it's very uneven. Not much savings, small amounts, and then huge amounts of savings at the end. And so I think you kind of have to look at where you're at in that spectrum as far as that goes. And then look really closely at where you are savings. 401k would be really interesting. Do you have a match? are you fully realizing that match? So if they'll match up to 3% and you're putting in 1% of your salary, man, make sure you get the full match because that's 100%. The company's going to help you save there, right? They're going to double your savings up to a certain percentage. And some of these matches are getting really competitive, and they're very, very good matches. So, that would be one area to kind of look at for catch up. I know, Ethan, you kind of keep track of some of the, like where you should be at certain ages. What do you see out there?
So, though these are rules of thumbs, I don't think they apply to everyone in every situation, but this is kind of just something that Fidelity threw out there
Hmm.
was that you should have one times your salary by 30, three times by 40, uh, six times by 50,
Okay.
eight times by 60, and 10 times by 67. But depending on your situation, maybe I'm a low spender in retirement. I don't need to save 10 times my salary then if
Right.
I'm a low spender.
Right.
So they're rules of thumbs, but it's very hard to use these rules of thumb when it applies to people, I'd say.
Yeah. So basically, a 67-year-old with $100,000 of income should have $1 million saved at that point in time under that rule of thumb. And yeah, it is. It's interesting. It does depend on kind of what you're going to do. Of course, we're planners, right? So, and we have access to unbelievable tools, and that's where we can throw the rules of thumb out because we can do it custom. It depends on each person. So, I don't care what age you are. If you tell me kind of what you want to spend, I can figure out how that's going to work one way or another and show you whether that's going to work or not. And if it's not, I can show you what you can spend. And then you can look at that and say, okay, well, I can do that. I can make that work or not. Right. And then you make some adjustments to other aspects of your overall concept for retirement. But yeah, I think that for us, not everybody has access to that, but that's why we have a job. It's why we have a business. It's why we have this show. It's why people keep coming to us because we can answer those questions. We can go through and show people, how that's going to work. And if you're behind, we can show you how. We can show you how to catch up. And we can show you what's going to happen and really for me personally, I just need a plan. I just need a path. If I have a path that I'm walking down, I feel very comfortable, I feel motivated. I change my mind, then I get to change the path. But that's not hard to do. And so I just keep a path going at all points in time. So I kind of know where I'm going. And man, I think there's huge peace of mind in that personally. And that's what we do for a living is kind of spell out those paths, adjust those paths as needed, and then help people kind of walk down that path. And I don't care if you're 20 or 80, it's still the same thing. It's still, everybody's got a path, something that they're thinking about. And if you don't have that path, what it does, in my opinion, it kind of creates this disconnect and you don't really know, right? And so I think it creates other problems. You don't know what you can spend. Hey, I got this opportunity to go on this great trip, but it's going to cost X amount of dollars. And without a path and without a plan, you don't know if you can actually do it. You think you can do it, but I can tell you if you can do it, at least, on a Monte Carlo simulation basis and what happens to your, overall Monte Carlo simulation when we put in that higher trip, that higher cost trip. Yep, it works. Nope, it doesn't, right? So I like those answers. That's better than this kind of amorphous, group that we kind of all run into most of the times for most of our lives. We can actually define the financial aspects of our retirement and really just sitting down with somebody like us, every 6 months to have a strategy session. It's unbelievable. It just gives peace of mind and it gives people that path. And then part of those strategy sessions are really for the clients to communicate changes that they might have in that path. We'd like to do this or that, or we'd like to start gifting money, and whatever it might be. And we can kind of create that and see if it works. And so I think that's an important aspect to what you want to do there as far as that goes.
And the nice thing with the software is these plans are live. So
Hmm.
it's not fixed, just as our lives aren't fixed. We can, 6 months later, I don't know. You can say, I don't know if I want to do this home remodel for this year. Maybe I want to push it back 3 or 4 years. And we can, how much better is my plan because of that pushing it back? Things like that. We have so much flexibility in testing these and like showing you what can actually happen.
Yeah. I mean, I don't know, home remodel that somebody's doing is going to cost 50% more, because contractors are in high demand right now, and there's, it's more expensive than they thought. And so then we could put that in and see, well, okay, still works, it doesn't work. What do we have to do? But what if you don't have the plans? That's the thing I always say to myself. I mean, I don't know how you answer that. You're just going to do it? And that's what happens most. Most people don't have a plan. Let's face it. I mean, it's a really small percentage of the population that probably has a live financial plan that they're meeting with a professional every 6 months about to figure out what their path is and to adjust their path, right? So we're talking about like very small number of people that are actually on that program as far as that goes. But I think it's the best place to be personally. Now, I'm biased. I get paid to help people make those plans, but it is still, I think, really powerful, and it's why we have a job and why there's a business here. So all right. Well, that's fantastic. I'm really excited. Those are some great questions, actually. Some of these were really thought provoking as far as that goes. There's a lot of stuff happening right now. And so, as usual, matter of fact, since we started this show on the 23rd of March, 2020, the bottom of the market, there's been just so much going on, the whole virus and things that are happening. So, again, really, really interested in trying to educate you. These shows are free. We're doing this bottom of our heart. If you never come to see us, I hope like heck you get something out of this as much as possible. But if you do want to come see us, you can, hit that book an appointment button and schedule a 30-minute appointment with us, and subscribe to the channel and all these different types of things. Continue to push your education in this arena and try to find some balance to all this negative news. Those would be some of my recommendations as far as that goes. So look forward to